Good to see you guys. So you guys are here for Zach and Douglas's excellent adventure. You're not Keanu Reeves and Ted Winter in a bad high school heavy metal band.
I'm wearing Iron Maiden shoes, though.
There you go. So the Bill and Ted analogy is not going to work completely, but you are two guys with long hair trying to modernize consumer finance. So there's some narrative thread. So let's start with how you got there. So Douglas, you were CIO of Google. You spent some time in the music industry before starting a lender, an online lender. And Zach, you were in consulting. So why, as you're thinking about starting a company, why finance? If you want to start off, Douglas, when you finish taking your sip of water.
I'll wait. I've been lucky in my career to be hanging out at places that were solving really interesting problems. And for me, interesting means mathematically really hard, and it matters if you get it right. And I've been sort of wandering around after I left Google doing some random stuff, including running a record label, which was quite random. And I realized that there's sort of interesting problem that had occurred. Since about 1950, underwriting hasn't changed at all. These two dudes, one named Fair and one named Isaac, kind of popped out of academia and realized, hey, we could use what at the time was the most advanced mathematics available, logistic regression, plus these credit bureaus and produce a generic score. Arguably, that's one of the top 5 innovations of the 20th century, although nobody seems to praise them for it. They should be praised for it. But things shouldn't be the same since 1950. Nothing else is. You know, computers have grown, right? Computation is free and infinite. Storage is free and infinite. Bandwidth is free and infinite. Like, why shouldn't you do something more interesting? And so I wondered, could we apply the math that we built at Google to the problem of credit underwriting and see value? And it turns out you can, and it does.
Zach, what's your story? How'd you end up in the back end of the banking industry?
So my story is a little different.
Wow, that came out wrong.
The plumbing?
Yeah, exactly. Okay, yeah, we build financial plumbing, I guess you could say. So my story is a little bit different. It's a bit more kind of accidental. So kind of early in career, a ton of time in kind of software engineering, writing code. And then landed at Bain, the consulting firm, and got exposed to basically working with financial institutions. And there's this big divide between kind of the work that we were getting paid to do at Bain and my history in kind of software. And you would just see time and time again these problems that came up with financial institutions, with banks, that should be solved by software, and yet weren't as much. Along the way, started spending a lot of time thinking about the impact that finance has on consumers' lives. If you ask a consumer what's the most stressful thing in your life, time and time again they say, money is the most stressful thing in my life. It's the thing that stops me from doing what I want to do. It's the thing that stops me from having the life I want to have or spending time in the way that I want to spend it. It's the limiting factor. And so early on, when I ended up leaving Bain, my co-founder and I set out to build a set of products that enable consumers to live better, simpler, easier financial lives. Allowed them to control the way they spend their money, the way that their money is used, so on and so forth. Consumers at the time, and this was 7, 8 years ago, they had a lot of distrust of the existing financial products that were out there. Our original push was in creating our own version of a consumer financial product. So how do you monitor your money better? How do you track your spending? How do you kind of build your budget? What we found is that it was impossible to build that because there was no infrastructure. In order to actually really do anything for a consumer, you either had to be a bank and have access to all the rails, or you had to try and build your own custom version of infrastructure, and then maybe you've created this one given product. And so we decided to build a platform.
So, I mean, there were other consumer finance startups out there who were building on top of existing infrastructure and getting customers getting traction, right?
But how many? I mean, there was PayPal, there's Mint.
When are we talking? What year was this?
7, 8 years ago.
Okay.
I mean, there were certainly others. Venmo had been launched a little bit before then, having trouble kind of gaining user adoption, especially kind of their ACH onboarding was pretty difficult, and they were using credit and debit cards. Tons of other products that were out there in the nascent phases, but weren't able to truly hit scale. And so I would say we frankly got a bit lucky to pivot into building this infrastructure. But the thread that kind of unites our company is we want to make money easier for everyone. So we want to make money easier for consumers, and a great way to do it is to build a platform that people can use all over the place. Be that banks building better bank products, be that non-banks building better FinTech products, both.
So I think what we've seen, and you'll correct me, You'll correct me if I'm wrong, and you'll probably think I'm wrong to some degree, but what we've seen in fintech startups the last couple of years, at least the more successful ones, is they grow in a particular market, largely through a millennial or a younger audience, possibly through a lending product or money management or stock trading or payments, and then they start to branch out into banking services, and then all of a sudden they want to collect deposits, and then they kind of want to be a bank, but they're not going to get an FDIC license, and so you sort of get this image of, you can do one thing and do it well, but eventually you have to expand, and that becomes harder. So are we going to see startups turn into these full-service banks? And if so, do they need FDIC? I mean, do they have to, work that closely with the government?
So I guess my answer would be, good Lord, I hope not. If you go back to Frederick Winslow Taylor in the early 1900s, the theory of the corporation talks about transactions cost and using corporate structures to minimize transaction costs. And so because transaction costs used to be quite high, these big multi-line corporations and multi-line banks came together because it's just too hard to make it work otherwise. Transaction costs are to first order 0, right? So why wouldn't you let companies specialize in what they're good at? Like, I'm not going to become a bank. I'm not good at taking deposits. I don't know how to do that. I'm not good at running checking accounts. I don't know how to do that. I'm really good at selling underwriting tools. And the banks in the room should get to do what they want to do, and I'll do what I create value to. You're up.
So we've actually seen, Plaid, we work with about 2,500, 3,000 financial products out there. And so we see tons of different fintech products built by really everyone in the ecosystem. And I've kind of over time been developing this theory that if you look at what a bank was 5-10 years ago, it was kind of a monolith, or it is a monolith. Most of the big banks, they have every product for every person. You can walk into a bank and say, hey, can I have a checking account to hold my $25? Can I have a mortgage to buy a house? Can you help me plan for retirement? Can you give me a business loan? Can you give me really everything? The shift that we've seen over the past 5 years or so has been going to these kind of more microservices. So there's a specific product that'll let you get a $2,500 loan. There's a specific product that'll let you get a mortgage. There's a specific product that'll let you pay a friend or make an investment or buy a Bitcoin or whatever it is. And different demographics. So when you're in the monolith, all of the demographics went to the monolith because that's where you went. Now, when you have a bunch of different microservices, the demographics are going kind of like differently. They're distributing differently. And so what we're starting to see is that, a lot of these point services, a lot of these microservices are starting to rebundle, but they're rebundling around a specific need for a specific demographic. Wow. So it's for people of a certain income level, or people that have a certain preference, or that have a certain kind of investment philosophy. The rebundling is occurring in these kind of smaller areas. So we do see a lot of it. I don't necessarily know that any of the desire of those applications is to build a full stack bank. I think it's really just to serve their demographic well and giving them the products that they need to do so.
And do you envision some of these companies becoming deposit-taking institutions along the way, whether it's to become a full-service bank or not?
Well, I certainly imagine that they will. Whether or not it's their own deposits, whether or not they're kind of doing the rent-a-charter thing, whether or not they're partnering with another financial institution to actually enable that. Alex Van Pelt, when he was on stage a little bit earlier, talked about every company is becoming a fintech company. Uber, for example, they want to give their drivers bank accounts. Uber's not going to give them a bank account because Uber's not a bank. They're going to partner with someone to give them a bank account. So it's more about distributing the functionality than it is about who actually holds the deposits.
So Douglas, you've been doing Zest for about a decade now, right? And I mean, I remember talking to you early on about the efforts to do underwriting based on data that banks don't use. So whether it's social data, other data out there that we all have, but has not made its way into credit scoring to date. And through, I'm gonna completely butcher what you do for a living, but you take all of this data, you create models from it, and you do underwriting based on those models, and the models get smarter over time, and you get better underwriting. Where has the biggest hurdle been to get from where you wanted to be a decade ago to where we are now?
So you did mangle what I did.
Yeah, and my intention wasn't to mangle it, but, but having only been speaking to you for a decade, I can't.
That's right, like how long? Zest sells tools to banks to help them get, every bank in the world has like some number of people sitting in closets somewhere doing ML modeling, and they're probably doing a pretty good job of it. Like, I mean, modeling's a little bit of a solved problem. But the problem is they can't get from that lab into production. And what my tools do is make it possible using kind of clever AI to take that person's model, take her model that she just finished building, pass it through model validation and your regulators, and get it into production. So we use a bunch of AI to manage a bunch of AI. And I think the question you asked, the biggest barrier, I think what you're looking for is me to complain about the regulators, which has actually not been my experience. The regulators have actually been quite accepting and really clearly trying to fulfill their mission of serving the country as an honor as opposed to as a job. I think ultimately the biggest barrier actually has been the internal structures of our clients. So I was the CIO at Google for a very long time, and one of the things I tried to do is figure out what governance should look like for technology inside a pure technology company. And ultimately what I tried to do is decentralize everything I could except the core things that were shared across the entire company. So a couple of different data stores, a couple of different search algorithms, and as we walk into companies that still have traditional CIOs, it's sometimes hard for them to figure out, well, should they do this work or not? Because they don't know the value, they just know the cost. And so I think that's actually the biggest barrier we've had.
So getting customers to understand the value of what it is that you're providing and how that can help their underwriting or help their lending process?
Well, as part of the tool implementation, you get a model that says, here's how much you could save if you took out all the losses. Mm-hmm. Most people don't. Most people take it all to approval rate, and our customers get between 15 and 30% increases of approval rate with no increase in losses. So they get this massive win, and they already marketed to all those people, so those are basically free accounts. But so you know what the economic return is going to be. So the business folks are like, hey, I want that. Thank you very much. You show up at the CIO, and the CIO is like, okay, to implement this, I'm going to have to go touch my loan origination service. I'm going to have to go touch a bunch of data. Like, if I mess this up, I'm going to lose my job. And if I get it perfectly, that person's going to get all the benefits. Why should I do this again? Which is not a totally unreasonable question, actually.
And what about the ability for machines to underwrite? Where are you on that now, and where do you think we're going?
So it's easy to teach a machine to do something dumb. You probably shouldn't do that. So for example, one of our early clients, just for fun, we were trying, what if you let the machine do it all? Let the machine do select the variables, let the machine build the models, let the machine do everything. And we got this, got a model, right? That is what you get. And that model predicted that you should approve every loan coming from Arkansas. I'm from Arkansas.
As we both are, one of the things we originally
One of the things we could.
Yes.
Arkansas is a lovely place full of very nice people. Great vacation spot, not a place you should give all loans to. And it just turned out that actually there was exactly one loan in the trading set made to Arkansas and that person paid back. Therefore, 100% of loans to Arkansas paid back, so you should make more loans to Arkansas. You can get a model to learn something dumb. You probably shouldn't. And so part of what we spend a lot of time trying to do is make models that aren't dumb.
Zach, talk about banks as friend or foe for how you're selling your product and going to market.
Fair. I think it's kind of an interesting question you can even almost abstract to all of FinTech. So we are, again, enablers of FinTech. We kind of build the infrastructural platform that allows a consumer to interact with their money, interact with their data in the place that they want to. Many of our biggest customers, most of our biggest customers are banks, building kind of what I think is pretty cutting edge technology for their customers. We, of course, work with a lot of non-banks as well, so it's kind of par for the course that we spend a lot of time with everyone. But I think the interesting thing that we started to see more and more are partnerships between FinTech companies and financial institutions. When you think about where a consumer spends their time and who has the largest consumer base, it's the banks. The biggest banks have 30, 40, maybe even 50 million consumers. And that is an amazing distribution point for any financial product. What we've seen kind of time and time again over the past couple of years is examples of the banks themselves wanting to go and license or partner with a FinTech company and distribute that product into their user base and do something like a profit share, or revenue share, or a value share. Because the consumers are saying, hey, I want that FinTech product, and the bank is saying, well, I could build that, or I could partner with that, or maybe I'll buy it, and I can get it to market faster. So we are seeing kind of this increasing pace of partnership between fintech and financial institution, and I think that's really exciting because ultimately the consumer is winning. The consumer is getting more access to more products.
How much resistance have you faced from banks in trying to deploy?
I think in the early days, we faced a lot. We said, hey, we'd like to help create a more tech-savvy ecosystem. We'd like to go shake things up. We'd like to change things. And in an industry where many institutions make a lot of profit from things being the way that they are, it was a little bit controversial. What we saw over time is just repeating kind of the consumer-centric story, saying ultimately everything goes back to adding value to the consumer's life, helping the consumer take control of their money, make the decisions they need to make, get better products, tools, and services. It's incontrovertible. No bank would ever say, I don't want to help the customer. Certainly, I would hope they wouldn't. No product that I've seen would say that either. And so repeating that story over time kind of opened doors for us.
Venture broadly has been $131 billion invested by VCs last year, record number by far. FinTech has seen its share of that. SoftBank has been writing significant checks, billion-dollar-plus checks into the industry. What does the influx of capital mean for you, I guess, both your companies, but also your competitors, the competitive ecosystem? Any insights there?
So we haven't taken very much money. We've been privileged to run on our operating value for quite some time.
When was the last time you raised?
4 years ago. To first order 4 years ago, maybe 3 years ago. And we're lucky to have amazing partners on our board. And so I actually like my board meetings, which is kind of unusual. So I think what's interesting is that a lot of money has been cast at not great companies. The Financial Times did an article that came out now 2 weeks ago that said that they had done a survey of AI companies, and it found that 40% of AI companies in your finance had zero AI actually in their infrastructure. I have a friend from Google named Sergey Burkov. So Mark Andreessen famously said that software is eating the world. Sergey Burkov, by the way, not Sergey Brin, to be clear. Sergey Burkov said it's actually that BS is eating the world. And he went off and did a survey and found more like 80% of AI companies have no AI in them. I'm looking forward to the hype cycle being over. I'm looking forward to there being less money put into fintech. I was in the first AI bubble 25 years ago, and when money started flowing in, productivity and quality dropped. But when the money went away, both increased. So I'm sort of looking forward to that.
So we just raised $250 million.
A lot.
And hopefully we're not one of these companies that you speak of. Though our, again,
we'll just claim to have AI.
Yeah, we don't claim to have any AI. We're plumbers, right? Financial plumbers. So we have raised a fair amount of capital. I think, though, on the back end, we've actually been quite efficient with the use of capital. So the team, relative to the size, relative to revenue and relative to most metrics, the team is still pretty small and lean, and we actually really like that. I think it kind of keeps you healthy. I think just speaking a little bit more broadly about the ecosystem, having a bunch of capital means there's a bunch of different bets being placed. And what we've seen is that the traditional way that you place a bet, so you launch a product and then you go try to acquire customers, and you're spending a lot of money on advertising to go try to acquire all those customers. The traditional path of getting big for a fintech company, that's getting hard. It's getting really hard. Customer acquisition costs through paid advertising used to be when Instagram first launched their kind of advertising platform, it was amazing. You could go out and buy all the users you wanted to for basically nothing. Turns out Instagram's now very expensive, and all of the other paid platforms are very expensive. And so what we're actually seeing is that the fintech companies that are able to acquire through referrals, through organic, are growing so well sustainably and for a long time, and those that are just paying are not. And I think going kind of one layer deeper, what that tells you is that the companies that are able to kind of focus on acquiring within networks, so creating networks of people, again, this demographic push, if you can get a demographic right, you can get people to tell their friends about it. That's a really big deal. And people that are building the best products are continuing to win. And so I would say in a capital-rich or a capital-poor environment, we might see more bad bets. We might see more bad choices in a capital-rich environment. But the companies that win are still the same. It's still about product quality. It's still about serving the consumer in the best way you can.
So you'll have 30 seconds each for this last answer. But so we can honor the spirit of the session, let's imagine that you guys are Bill and Ted, and you have access to Rufus's time machine. Rather than traveling back in time to collect historical figures so you can save the future with your history exam, you want to save consumer banking. And so what's one thing that you could, if you could go back in time and change to save consumer banking, what would that be?
Wow, if I could go back in time and I wouldn't say excellent very many times. I would change building loan origination service systems on kind of scary bespoke platforms, because having it on a more kind of shared influence, I mean, and I don't care which one, to be clear, would make it easier for companies like Plaid, would make it easier for companies like us, would make it easier to unlock the value out of that bank. So there's my 30 seconds.
So we heard Jamie Dimon say recently that JP Morgan is a FinTech company. They are a tech company. And that represents a shift in mindset. Whether or not it's true, I'm not commenting on. But the fact that banks are now thinking of themselves as tech companies is just, that's the biggest thing. And going back 10, 15 years saying banks should be thinking of themselves as technology companies, that would be huge. When you look at the platform cycle, so the shift to the internet, the shift to mobile, financial institutions are 3, 5, 7, 10 years behind in general, the rest of technology. And so going to the banks and saying, you are a technology company, please try to keep up. We're starting to see those cycles shorten, so banks are now actually getting much closer to keeping up with the platform shifts. But getting that message out more broadly, a little bit longer ago.
Excellent. Thanks, guys.
Thank you.